What a start to the week. Live from New York City this morning. Good morning, good morning. Equities just about negative on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, coming up, the U.S. backstopping bank deposits of failed banks. Goldman Sachs dropping its call for a rate hike this month as equities struggle to bounce and bond yields plunge. We begin with the big issue. Things begin to break. The United States. The president preparing to address the nation after U.S. authorities took new measures to shore up confidence in the banking system. Late Sunday, the Treasury Department, the Federal Reserve and the FDIC said it will wind down two failed banks in a way that, quote, fully protects all depositors. The central bank also announcing a new bank term funding program that offers one-year loans to other banks in America under much easier terms. The Fed and Chair Powell now finds itself between a rock and a hard place. Goldman Sachs dropping its call for a rate hike this month as Chair Powell attempts to respond to financial stability risk and above-target inflation simultaneously. Here's the President of the United States.
Signature Bank. Today, thanks to the quick action of my administration over the past few days, Americans can have confidence that the banking system is safe. Your deposits will be there when you need them. Small businesses across the country, the deposit accounts at these banks can breathe easier knowing they'll be able to pay their workers and pay their bills. And their hardworking employees can breathe easier as well. Last week, when we learned of the problems of the banks and the impact they could have on jobs of small businesses and banking system overall, I instructed my team to act quickly to protect these interests. They've done that. They've done that. On Friday, the government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. And over the weekend, it took control of Signature Bank's assets. Treasury Secretary Yellen and a team of banking regulators have taken action, immediate action. And here are the highlights. First, all customers who had deposits in these banks can rest assured, rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the deposit insurance fund. Because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them. Second, the management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Third, investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. And fourth, there are important questions of how these banks got into the circumstance in the first place. We must get the full accounting of what happened and why those responsible can be held accountable. In my administration, no one is above the law. And finally, we must reduce the risk of this happening again. During the Obama-Biden administration, we put in place tough requirements on banks like Silicon Valley Bank and Signature Bank, including the Dodd-Frank law to make sure that the crisis we saw in 2008 would not happen again. Unfortunately, the last administration rolled back some of these requirements. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again, and to protect American jobs and small businesses. Look, the bottom line is this. Americans can rest assured that our banking system is safe. Your deposits are safe. Let me also assure you we will not stop at this. We'll do whatever is needed. On top of all this, let's also take a look at a moment to put the situation in a broader context. We've made strong economic progress in the past 2 years. We've created more than 12 million new jobs, more jobs in 2 years than any president has ever created in a single 4-year term. Unemployment is below 4%. for 14 straight months. Take-home pay for workers is going up, especially for lower and middle-income workers. And we've seen record numbers of people apply to start new businesses, more than 10 million of them, more than 10 million applications over the last 2 years starting businesses. Now we need to keep this progress going. That's what swift action that my administration over the past few years is all about. Protecting depositors, protecting the banking system, protecting the economic gains we've made together for the American people. Thank you, God bless you, and may God protect our troops. See you in California.
Mr. President, what do you know right now about why this happened? And can you assure Americans that there won't be a ripple effect?
A brief address from the President of the United States there. 4 brief points from President Joe Biden. The effort here to protect customers with deposits, really tried to emphasize there that no taxpayer dollars will be put at risk, that they will look to make sure that those that are responsible will be made fully accountable and will not protect investors of these failed institutions. Your team coverage begins right now with AMH down in D.C. and Katie Lyons alongside Mike McKee here in New York. Anne-Marie, this is not a bailout, I think, is the communication effort from this administration this morning.
Oh, that's exactly what the president wanted to make clear before he wheels up, Jonathan, to California, that this is not going to be out of taxpayers' dollars when it comes to protecting those deposits at the bank, the Silicon Valley Bank this morning. The 4 points, all customers that had deposits, he wanted to rest assured. If you have deposits in these banks, if you are a small business, you need to make payroll, you will get your money back. 2, no losses will be borne by taxpayers. These will come from the FDIC. And of course, it's the fees that the banks pay into the FDIC. Management of these banks will be fired. Direct quote from the President of the United States. He's saying the FDIC is taking over these banks. Those executives will be gone. And then investors in the banks will not be protected. To your point earlier, this is more of a bail in. The other thing the president said, Jonathan, and this is the big signal to Democrats and Republicans on the Hill, is he is calling for more regulation, and he also did make sure he had a moment to talk about Dodd-Frank and some of that rollback of that regulation we saw under the Trump administration in 2018.
Stronger regulations are coming. AMH, you and I talked about it a little bit earlier this morning. Pretty clear that that was going to be around the corner. It is. We'll talk about it a little bit later. Katie Lyons, is it sufficient? Have they done enough?
It doesn't look like the market believes that this is enough, either that lending facility provided by the Federal Reserve or the fact that all the depositors in both Signature and Silicon Valley Bank will be made whole. The regional banks are not buying it this morning. Just take a look at the shares of First Republic, for example, in pre-market trading down 62%, and an ETF that tracks those regional banks is down 8.8%, and it's bleeding into the broader financials too. That broader financials select sector spider down 3% right now in pre-market trading. It does not seem like everyone is convinced that this is going to stem the risk of something systemic happening here. And certainly, given that investors are not going to be made whole in these banks, maybe no one wants to risk being left holding the bag, hence why you were seeing the selling pressure today. I would note, too, that this is bleeding into the broader economic and monetary policy thinking this morning as well. You see that reflected in the bond market, just an absolutely massive move happening in yields this morning. Right now, the 2-year Treasury yield down another 42 basis points on the day. We are now down more than 90 basis points over the course of the last 3 days. We have not seen a 3-day move like that since Black Monday all the way back in 1987. This is a massive repricing of what things breaking in the financial system ultimately is going to mean for the trajectory of the Fed's policy, John.
And day 3 of that move is not over just yet. Mike McKee, that tees us up nicely. The Fed's next move, we've got CPI tomorrow, retail sales on Wednesday. If the chairman could do that address all over again this morning, Mike, what would it sound like?
It'd probably sound the same with some of the things that the president said thrown in as well, because the Fed doesn't know what it's going to be like 10 days from now. Now, you go back a year and you look at what's happened and you can see where the problem came. That's the yield curve. The bottom is the day before they started their tightening process, and the white line is where we are now, even though that's come down some, as Kayleigh was mentioning. And the problem is, of course, that if you bought bonds at the blue line and you now own them at the white line and need to sell them as the banks do, you're losing money. And that's created the problem here. So what did the Fed do over the weekend? They created this bank lending program. So a bank that is forced to sell some of its assets can instead take them to the Fed and get a loan for their value at par. It's similar to the discount window, but they do get a year instead of 90 days to pay it back. And there's no haircut on the value. And the Fed also supported the FDIC's systemic exception to cover uninsured depositors. Now, the dirty little secret is uninsured depositors are almost always made whole in bank resolutions. Been a very long time since that hasn't happened. IndyMac, the last one in 2008. Where does it leave the Fed? Well, as I said, 10 days from now, they will be making a decision, not tomorrow. So they'll watch what happens with the banks. But you can see how market expectations have changed. Now we're basically pricing in about one more move, 25 basis points to about 5%, but not quite even that. And so we're going to have to see what happens, because we have CPI tomorrow. We have PPI on Wednesday, John. And if these banks make it through the next day or two, the whole narrative may change.
Mike McKee. Thank you, sir. Kelly Lyons, Anne-Marie, the three of you staying close through the hour, no doubt. Equity futures right now down 0.75%. In a world where a bank can fail in something like 24 hours, 10 days is a long time. In the bond market right now, as Kelly pointed out, yields lower by more than 40 basis points on a 2-year, 4.18. Worth pointing out repeatedly that we were close to 5.1% in Wednesday's session just last week. So as Kelly mentioned, it's not even 3 full trading days and we've seen a monster move in this market. Let's discuss it with CreditSights Zach Griffiths, RB Advisors Mike Contopoulos. Now, Mike, as you know, buddy, the Fed gets to decide when we start hiking interest rates. This market gets to decide when they're done. Has this market just decided they're done?
Well, I think that's clearly what the 2-year is telling you. If we look at the move over the last several days, it's pretty dramatic. Obviously, the ultimate terminal rate has been priced quite a bit lower. And cuts have been brought forward a little bit. Pause has obviously been brought forward a little bit as well. And 25, is certainly the go-to bet, if not nothing, let alone 50. And so, yeah, I think the bond market is telling you that we're much closer to the end than we were, 4 days ago. I don't know if I fully buy it, but that's certainly what the market's telling you today.
Well, that's the debate, isn't it? Goldman says they're done this month. They won't be hiking, and what happens after that, we don't know. But quite clearly, Zach, there are two very clear camps developing this morning. One is that the market's right, they're finished. The second is that the Fed over the weekend, together with US authorities, has shown they have the tools to address failed banks and can focus on tackling inflation. Andrew Hollenhorst, the City, in the last hour published and said this: a policy rate hike remains very likely next week. Recent bank failures were unlikely to be systemic before the Fed acted, and that possibility is even more remote after officials signaled even uninsured deposits would be protected. So, Zach, to put you on the spot, which one is it?
I'm inclined to agree with all that. I think 25 basis points is still very much on the table. We have CPI tomorrow. I think, if anything, the recent trends in inflation have been going the wrong way, or at least shown a pause in the disinflation that we've seen. So I think the Fed is still going to be beholden to the inflation and labor market data when it sets policy in 10 days from now, as they've already addressed the immediate concerns from a liquidity perspective dealing with these banks. And so I think for now, as long as CPI comes in close to in line with expectations, another hike is still on the table, as the labor market and inflation really aren't giving the Fed signs that it can pause just yet.
And so, Zach, what do you make of this move at the front end of the curve, not just in the US, but in Europe too, in Germany?
It's a huge move, and it's showing that market expectations have repriced significantly. And I think that makes sense, more so from a terminal rate perspective. I'm not so sure that the Fed or the ECB or other major central banks that still need to tighten policy to address inflation are done just yet. But it makes a lot of sense to us that we're not going anywhere near as high as the market had been priced for last week, as taking out those potential additional incremental hikes seems unlikely given the unexpected move and just all of the uncertainty that's in the market now.
Well, the last month has been dominated by a conversation about maybe this Fed going even further, that these longer variable lags might be a whole lot longer. Mike Wilson of Morgan Stanley, publishing earlier this morning, he said those longer variable lags are here right now. He said the past week witnessed the sudden collapse of SVB. The real story for equity markets is the impact of the Fed's actions over the past year. He goes on to say earnings growth expectations remain materially too high, and the markets are now likely to price that risk more quickly. That's the equity story. Michael, what does that mean for credit?
Well, you know how we've felt about credit, Jonathan, for the last several months, which is that, there's really very little upside. I think the last time Zach and I were on, actually, we had a good debate about this. Credit markets are priced to perfection. They've widened out a little bit over the last several weeks, but we still think, listen, when you're in an environment where you're in an earnings recession, where equity volatility up until recently has been very, very low, which credit spreads tend to follow equity volatility, when you have leverage metrics, interest coverage metrics deteriorating, when you have an increase in downgrade risk. I mean, none of these things are good for the investment grade market, let alone the high yield market, where defaults are also picking up. And, I think investors are often confused by the fact that, maybe corporate credit is higher quality than it has been in the past. And I think, you could maybe make that argument. But that doesn't mean that names won't get downgraded and funding costs need to go up and spreads need to widen. That doesn't mean that volatility isn't going to go up and spreads are going to widen. And so I still think, particularly investment grade credit, is one of the worst relative value propositions I have ever seen in my career versus what you can create in the treasury market or in really, really high quality structured products. And I can give you, AAA CLOs paired with long-term treasuries and have virtually none of the credit risk of the investment grade market and all the yield and the upside of falling rates. And so to me, credit just makes no sense right here. And as a consequence, we almost have no credit exposure across our portfolios.
Zach, are you still taking the other side of that?
I think my response is a bit more nuanced than it was a month or two ago. I think that from a strategic perspective, we still think there's good value there. And I certainly take the point that the amount of spread pickup you're getting by owning IG versus treasuries is quite low historically. But we do think that there are still attractive opportunities. And when we think about how we want to position from here, we've been in the tactically cautious camp for about a month. I think that's going to remain prudent for at least the next couple of weeks as we let things shake out here. But we're not bailing on our strategic view of kind of overweight in credit, just given the strength of the U.S. economy behind this. And our bank analysts have been adamant that this is not a systemic issue in the banking system. And we think the Fed has moved to take care of the immediate concerns. And it remains to be seen kind of the second and third order impacts of this. But we're not changing our strategic views just yet.
So one tool they announced yesterday to address some of that was this new bank term funding program that offers one-year loans to other banks in this country at really, really favorable terms. Capital Economics was straight out on it yesterday evening, after the news came out. They said the shift to accepting collateral at par rather than marking to market means the banks that have accumulated more than $600 billion in unrealized losses on their how-to-maturity Treasury and MBS securities portfolios should be able to ride out the storm. Zach, as you know, these securities, treasuries, whatever, they're deeply underwater. To be able to post that collateral at par, how transformational is that? How big is that announcement yesterday?
That's a huge move, and it really addresses the core of the issue that Silicon Valley had to realize in selling those securities that were hugely underwater. Now that banks have access to this facility over a year at par, it essentially wipes out the concern of having to actually realize these unrealized losses that are in these books. And so I think it's a huge move, and it really addresses the core of the issue that we have in the, that we saw over the past couple of days, and addresses it quite well. So I think that that's really big for just how things are going to unfold over the next couple of days or the next couple of weeks, and kind of lets the Fed address monetary policy with the policy rate setting next week.
Mike, just to give you the final word, this word bailout is emotionally charged. Some people really fighting against its use, including, of course, the administration for obvious reasons. But this seems like one heck of a lifeline for poorly managed financial institutions in this country.
Yeah, it certainly is, Jonathan. And listen, at the end of the day, you had 10 years of infinite liquidity, and you're pulling back on that liquidity. And we've talked for a long time about long duration assets suffering from that, whether it be technology and venture capital or crypto, or long-term bonds for a period of time. Now we think that's kind of the other side of that, is that the growth story will pick up on the long-term bond side. But up until recently, right, we were very, very underweight duration as well. And so listen, this is what happens when you have tighter financial policy and you have an inverted yield curve, and you have that on the back of 10 years of infinite liquidity and low rates. I don't know what the Fed or the government expected to happen, but this seems to make a ton of sense. And quite frankly, is a little bit refreshing that you're now potentially going to have a reallocation of capital from tech and innovation and unproductive assets to maybe actual real assets. And listen, I think it certainly leaves us a bit uncomfortable with what the Fed is doing, and it effectively being a bailout, bail-in. I don't care what you want to call it,
sure,
but it certainly is a ton of moral hazard. But listen, at the end of the day, this is exactly what we should be expecting. It's going to have consequences.
Well, let's see if it's sufficient. And if it's sufficient, why is First Republic down 63, 64% at the pre-market? Mike, Zach, to the both of you, Fantastic to catch up with you. That move doesn't make sense if you think this move is sufficient by authorities in America. I want to get back to AMH down in Washington. Anne-Marie, we heard from the president about 20 minutes ago. This regulatory push, we can see where this is going, can't we?
Yeah, we certainly can. And Jonathan, already before the president came out and spoke, we heard from the likes of Senator Bernie Sanders, Senator Elizabeth Warren. These individuals have been talking and complaining about this deregulation that happened in 2018 since that bill was put to the floor. The issue this president is going to have is that obviously it's a divided Congress. You have the House being controlled by Republicans, which if you were watching the Powell testimonies last week, you have these individuals warning the Fed about the risks of having too much and too strong capital requirements on banks. So you're almost living in a parallel universe depending on which senator or congressman or woman you are speaking to. But going back to that 2018 deregulation we saw, this changed the oversight, this changed the threshold for small to medium-sized banks. 17 Republicans signed up for it. When former President Donald Trump signed that bill, he said this was a bipartisan effort, and he hopes to have more bipartisanship like that in Washington. AMH,
down in Washington, thank you. It's interesting you heard the president refer to the previous administration, but not those 17 Democrats that voted with the previous administration. We heard from the president just moments ago. Take a listen to what he had to say.
We must reduce the risk of this happening again. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again.
Got a fantastic guest lined up to talk about this. Henrietta Trace there of Vader Partners joins us right now. Henrietta, down in D.C., great to catch up with you. Let's just start here. What do you think's on the agenda now in Washington?
I have a terrible answer for you. The answer is that the House Republican Conference is going to leave for its issues conference, and they'll be out of D.C. for the entire week. So not a whole lot, to be really honest. And when they get back, I'm sure there will be hearings. The Senate will, of course, hold hearings and have continued briefings, particularly the California delegation. The House Democratic California delegation will continue to get briefings, but there will be no action out of D.C. this week in terms of legislation passing, certainly not what President Biden called for moments ago.
Henrietta, you heard from the president moments ago. He was very keen to point out that the previous administration had pulled back on some of the regulation around these small and medium-sized financial institutions in this country, regional banks, etc. How do you think Republicans will manage that message in the weeks to come?
I think they just place the blame squarely on President Biden. They pivot to inflation. They pivot to the Federal Reserve and interest rate hikes. They talk about the riskiness of the high-tech sector, the concentration of this bank. What I heard overnight from staff across the board, whether on Democratic or Republican circle sides, was a discussion of how this is a contained bank crisis that is explicitly in Silicon Valley, explicitly in high-tech sectors. It has no impact on, the heartland, the farming businesses or farming banks. And that's something that they wanted to see in order to get any kind of bipartisanship. And that was brought up in every conversation I had last night. This is considered in D.C. Very isolated and not really the problem of most of America is really the perspective.
The question I would have for them, if it is indeed that isolated and not a problem, why do you think they had to trigger the systemic risk exception?
My personal answer is that there was no chance of congressional intervention. There was no chance of any oversight. The reason that you have those classifications for systemic risk is explicitly because when you need to have control of those federal regulators and you cannot rely on Congress, they need to have the authority to act. And that law has been changed several times. We increased it again in 2008. To deal with the financial crisis and hike the insurance guarantees. And they have the authority to act on their own with the Fed, the Treasury, the FDIC, and the president. And that's exactly what they did because that was the only option they had available to them. There's no scenario where we get congressional action here for this year, in my opinion.
Is there a concern about moral hazard in the meantime, Henrietta, given that we've basically just told every bank in this country that your depositors will be made whole?
I think there's definitely the concern about moral hazard, and you'll probably hear a lot about that from lawmakers. One thing I'd like to just put in the easer for you and your watchers is that the Fed's discount window openness, the potential easing there is something to really monitor. I was in the Senate during the 2008 TARP votes, and one of the amendments we saw repeatedly was that there were going to be efforts to open the discount window so that you can access the information about who is going to be accessing the Fed's discount window. I would say prepare for that, at least an amendment, a headline risk, and you would see that come up maybe in whatever bill passes next. Could be as late as September with the debt ceiling vote, but that could theoretically be in June, and they'll start working on it probably with the budget in April. So be mindful as you get into that moral hazard question that opening the Fed's discount window so you can really access all that information is something that we've seen members, specifically Senator Rand Paul of Kentucky, offer in the past.
Accessing some of these Fed facilities, Henrietta, sometimes comes with some negative connotations, a stigma perhaps. How do they avoid that?
They don't. They're not even trying to avoid that. They don't really concern themselves with it, quite frankly. When those votes happen, and this is just my muscle memory recalling, those amendment votes come up really fast, and a lot of members are not familiar with exact details of what the Fed's discount window includes. It's a risk of politics and things escalating rapidly. You got to rely on leadership in the banking committees to make sure that that amendment doesn't pass.
What a crazy situation. Just this idea that they're all going to go away. Henrietta Trace of Vader Partners, thank you very much. Let's get straight to the price action for you. About 5 minutes away from the opening bout. This is the move in equities. We're down 8 or 0.9% on the S&P 500. And here is the monster move in the bond market. We are down 50 basis points on a session, there and thereabouts at the front end of the curve to 4.09%. That is about a 100 basis point move from the highs of Wednesday. That's not even 3 sessions. That's Thursday, Friday, and a little piece of Monday morning. On a 10-year yield, we're down by 23 basis points. And the curve's a bit steeper because of this. The curve is steepening by, let's call it 28 points right now, 28 basis points. But that curve steepening is being led by the front end. That's called a bull steepener. Now, bull steepeners typically develop this aggressively when things start to hit the fan. And I think it's fair to say that things are hitting the fan just a little bit. Coming up, the financials under pressure, even as regulators step in. That conversation up next with Ken Leon of CFRA and Academy's Peter Cheer weighing in too. All of that just moments away. This week has all the ingredients to be a long decade. Equity futures right now, negative 1.2% on the S&P and the Nasdaq. We're down 0.8%. These losses following the biggest weekly loss of the year so far on both the S&P and on the Nasdaq. And the Russell, heavily weighted to financials, struggling. There's the opening bell. Switch at the board and get to the bond market. Monster move. Those numbers are not wrong. We're down 22 basis points on a 10-year in America, 347.91. We're down a lot more than that at the front end of the curve on a 2-year this morning, down 45, make it 46 basis points lower, 4.12%. In the FX market, who knows what to do with this? We're repricing the Fed. We're also repricing the ECB. Euro dollar back to 107. We're positive there about 0.6%, and crude tanking. We're down more than 4% on WTI, 73.49. 30 seconds into this, here's the price action for you on the S&P. We open lower by a little more than 1%. On the Nasdaq, we're down about 0.9%. One sector to watch at the open this morning. It's the banks under pressure. Even after regulators swooped in to reassure depositors, the KBW Bank Index, worst week last week since March of 2020. Kelly Lyons back with us with more. Hey, Kaylee.
Yeah, worst week since 2020 last week, John, and this week is not starting out on a better note, despite the fact that depositors of both Silicon Valley Bank and Signature Bank are going to be made whole. And the Fed has announced this new bank term lending facility that is going to lend to banks at extremely favorable rates. That is not helping the regional banks this morning. Clearly, there is still fear out there about this spreading elsewhere. Just take a look at the shares of First Republic, down 65% here at the opening bell. This is on top of a 33% loss last week. A week ago, this was $122 stock. This morning, it is trading at $28 a share. That is how brutal this wipeout has been, John. And it's elsewhere in the regional banks as well. PacWest, Western Alliance, Zions, they're all down substantially in the first few minutes of trading here. Western Alliance down 70% with about a minute and a half into the trading session. We will see if these losses hold throughout the day. And it's bleeding through to some of those larger banks as well. The conversation we were having on Friday is these are diversified financials. They don't have as much risk They don't have as much concentrated exposure, so they were relatively more resilient, but that is not the case this morning. Really, all of the banks are lower. Right now, Citigroup, Bank of America, Wells Fargo, all down in the ballpark of between 4 and 5%. JP Morgan, the relative outperformer here, but still down the better part of 2% early in the session. And of course, we have seen the banks under pressure for some time now, John, but it is the regionals that have been lagging over the course of the last year. Again, the concern here being that they are more exposed to the Fed's rate hiking cycle, and it's raising questions this morning about how much further the Fed realistically can go when you are seeing this kind of pain in the regional banking sector, John.
Those names getting absolutely battered. Kelly Lyons, thanks for that. A lot of analysts weighing in on the situation. We spoke to Jared Cassidy of RBC. He published this. He wrote the following: though we recognise we are not out of the woods, there is a light shining through that will lead us out. This sounds promising. We expect there will be opportunities over the near term to buy banks as the market realises the actions announced yesterday will limit and prevent future bank runs. That last line. Can we go back to that board with all the banks on it and just look at that last line? Jared Cassidy of RBC believes at some point this market will realise the actions announced yesterday will limit and prevent future bank runs. And we still look like this morning. First Republic down 65%, PacWest down 36%, Western Alliance down 74%. CFRA's Ken Leon has this to say this morning: the fallout of this idiosyncratic episode is higher perceived risk in the financial system and worries about contagion that we do not see ahead. The larger banks are likely to gain market share from smaller banks in the current environment. Ken, I'm pleased to say, joined us right now. Ken, can we just start with the market action this morning? You and I have got a lot to talk about, but what do you make of these moves in the early part of the session?
So there's investor worries really on the depositor side to see if there's going to be an exit out of some of the smaller mid-sized banks. Larger banks are fortress balance sheets. That's the deposit side. The other side is really what triggered this was really their debt investment in securities like mortgage-backed securities held to maturity. If we had any change from the Fed that say perhaps clean it up in 1 year, that becomes a risk at large for the industry. We don't see that, but that's what really unwinds in this kind of market, is trying to create confidence. I think the president did that for the general economy, but as we look at equities here, there's still all the stirrings as it relates to what is here. Now, what's different than 2008 is these are transparent assets. They're all in the 10K, and it's just a question of going through each of these banks. Obviously, the ones that had concentration in deposits got hurt quickly. First Republic today, especially with the Fed and JP Morgan coming in for $70 billion, but it hasn't helped. So obviously, the equity markets are very worried.
I mentioned PacWest. It's been halted for volatility, dropped 41% to the lowest on record. These are some monster moves. Ken, there were two real announcements from yesterday. One conclusion that ultimately they're going to move to fully protect all depositors. So that's one. Two, if these banks elsewhere, not the ones that failed, but the banks elsewhere, if they've struggled to manage effectively their interest rate risk and they've got all these securities underwater, they can now post them as collateral at the Federal Reserve for this funding, this facility, at par. Now, Ken, do you think those two moves are sufficient to prevent there being another Silicon Valley Bank, anything that looks like that in the coming days?
Absolutely not. And I think what you're going to see, and visibility, is going to be Michael Barr, the vice chair at the Fed for supervision. And you're going to see a legion of regulators like we saw in 2008 sit at banks. It used to be greater than 250 billion, too big to fail. I think you're going to go down to maybe even $50 billion of assets where the regulators, and they should have been there as the firefighters, but they weren't there. By Friday, when you have the FDIC, it's like the police coming in. So you're going to see very strong regulation, not only on capital, but also liquidity, stress risk, and also credit risk. These are going to have impacts on the economy. And the other thing on the monetary side is that we haven't talked about this in the last few days. The Fed was supposed to reduce its balance sheet of $2.3 trillion by $95 billion, with $35 billion for MBS and $60 for Treasury. That's probably not going to happen right now. So, the monetary will focus, the Fed will do what it needs to do there on inflation, but you got to watch the supervisory side, and that's led by Michael Barr, who was one of the architects for Dodd-Frank back in 2011.
These moves are huge. So PacWest halted for volatility. That dropped 41%, the lowest on record. First Republic now paused due to volatility. When I say volatility, we're talking about these banks getting absolutely hammered. Big downside move. Schwab dropping 19%, pause for volatility. Regions Financial Corp. I can just keep going through name after name after name after name. Ken, it's not just those that are lower this morning, also some of the big SIBs as well. Ken, can you talk to me about the valuation, the line that you would draw between the difficulties these lenders are having and what might not be happening elsewhere with the big institutions on Wall Street?
Well, first, of course, as an opportunity to buy stocks that have sold off is if they're trading near book value or below. That's probably true for many banks today. When you look at the fundamentals and the issues we have today, certainly large is safer. And certainly, I think there's going to be a flow more not only to the 6 largest banks, and most of them don't have exposure to unrealized loss on mortgage-backed securities. Just JP Morgan and Bank of America, and we're fine there. But the PNCs and some of the larger banks are going to be fine. It's really what's in the weeds for some of these smaller banks, and they're going to get the headline news. But right now, the institutional money is saying, we need to move on the sidelines and try to figure this out.
Ken, just quickly on net interest margins for some of those big banks, there was a fear they might have to start putting interest rates up for the deposit base. Given that you think so many of these deposits will flee to them just purely for safety, that's your view, Ken, ultimately, where does that leave NIMS?
NIMS is going to narrow, and that means, in terms of, where net interest income is 50, 60% of your total net revenue, it's going to slow down. So it's definitely a concern.
For the big banks as well, Ken, you think they'll have to put deposit rates up too?
Probably not, because they're so diversified. They have a high percentage of just consumer deposits. Many of them are, you also look at non-interest bearing versus interest bearing. You add these all up, it's called a deposit beta, and they're going to be okay. It's just you just don't have this great bull scenario for banks because of rising rates. That's off the table. And to your point about NIM or net interest margins.
Ken, just a final one from me, just to put a bow on this. Are you saying you expect there to be another bank failure this week?
I'm not going to go there. That is a sensitive issue. But I think everyone who covers this industry is going, it's all in the 10Ks. And that's what we do at CFRA. We look at that. We put out quarterlies on delinquencies and everything else. On the credit side, we're watching areas like the credit card, but it's just beginning.
Yeah.
But it's all there, Jonathan, and I think this all gets flushed out today and tomorrow.
Ken, that's a hugely responsible response to that question. Thank you for that, sir. Ken Leon there of CFRA. Equities more broadly on the S&P. About 10 minutes in, we're lower by 1.25% on the S&P. Katie Lyons down in Washington. Katie, these are some big moves on some single names.
Yeah, they're massive moves. I mean, the KBW Bank Index as a whole right now is down 12%. And we have a lot of names, specifically some of those regional banks now halted for volatility, including First Republic, which at the time of the halt was down 65% intraday. And again, that follows a 33% loss on the week last week. Western Alliance also halted, down 76% at that point. Regions Financial halted at a 20% loss. And even Schwab now down about 19%. It, too, has been halted for volatility. That just goes to show you there is some kind of puke happening within investors for these banks, John, because remember, yes, depositors of Signature and Silicon Valley Bank are being made whole. Shareholders are not. And whether or not you think that is warranted from a policy perspective, that may mean that people just do not want to be left holding the bag here. So you are seeing some very real pressure in the regional financials. And as I mentioned, it is bleeding through to those diversified financials, the big guys as well. Bank of America right now, for example, down 7%. It does not appear at this point, John, that the market is buying what regulators did over the weekend as being enough. Not that facility from the Federal Reserve, and again, not the fact that depositors in these banks that have already failed are being made whole. There still seems to be a great deal of concern present right now in equity markets, John.
Kelly, thanks for that. Kelly Lyons, stay close down in Washington, D.C. With us now is Peter Cheer of Academy. Peter, I want to come straight to you on some of these moves. Either you believe that the moves yesterday from authorities, and welcome to the show, by the way, Pete, what a time for it. Either the moves yesterday evening weren't sufficient, or this is a monster buying opportunity in some of these banks. Which one is it, Pete?
So I think it's going to be a buying opportunity. I started buying Friday, obviously too early. I do think we're going to see more and more from the Fed. Having said that, it's not surprising. They didn't quite do enough this weekend. And also the complete narrative has changed. At this point, the only thing everyone's thinking about, and I think partly rightfully so, is unrealized bond losses, right? Nothing else matters. Everyone's got their attention on unrealized bond losses. So anyone with accrual accounting, whether it's banks or financial institutions in general, are going to come under severe scrutiny. And the lending program, while interesting, doesn't do a lot of that. To me, it doesn't fix right. It's if you had $100 of deposit and you need to sell bonds before that are worth 90 cents on the dollar, okay, you had to monetize that 10-cent loss. Well, now you get to park at the Fed, borrow 100, but you haven't fixed that loss. So I think that's going to be the thing that solves this market, is starting to get to a sense of how big these unrealized losses are and how you get around that.
So, Pete, you said they need to do more. Can you tell me what that more actually is?
Well, I think one thing is we really should have pushed harder to get some sort of private solution for SVB, right? Something where someone comes and buys it. We see something done other than just this guarantee and this vague word about we're not protecting the debt holders or the equity holders. So I think Haley was exactly right when she just mentioned that people are going to sell equity in these other banks because the equity has been unprotected. I think we need to figure out, how do we get some of these companies merged? How do we get some of them bought? How do we start thinking them as ongoing concerns again and not just a bunch of bonds on a balance sheet?
Pete, I want you to be really specific about why you think these single names are down so hard this morning. There will be a group of people sitting at home who ask themselves the question over the weekend, do I need to open a new bank account Monday morning? There will be others that saw the solution last night, yesterday evening here in the United States, as effective enough to tell people in this country, your deposits in your financial institution are safe, you will be made whole. And Pete, then we wake up this morning and we see this, the KBW Bank Index down 13%, and name after name halted for volatility because ultimately they're crashing in the early part of this session. Pete, what's driving that ultimately?
So I think last week it was a depositor story, right? It was worried about depositors fleeing, depositors not getting their money. The Fed fixed that to a large degree. But this morning, everyone's worried about what is the size of hole in these banks' balance sheet, right? How much unrealized losses do they have? How do we figure that out? And why do I want to hold the equity? So this has become a, not hidden loss, but an accounting loss issue, as well as why would I want to hold this equity regardless of where the deposits are going? So that's what has to be addressed now. So I think the Fed did a lot towards fixing what was last week's problem. Now they got to get ahead of this week's problem.
So let's talk about second round effects here, Pete. What are they?
I think the jobs, first and foremost, of the Fed has to be no bank runs, right? Whatever inflation, we can all worry about that. Bank runs, as we saw during the great financial crisis, if you let the financial system slip into some point where it's not functioning, where people don't trust it, all hell kind of breaks loose in the entire economy. So this has to be priority number one. I think we've got to make sure the politicians stop taking advantage of these for sound bites. This is not the time to reprimand people, criminalize people. That can be done down the road. But they have to avert this. I think they've got to be sitting today desperately working hard towards, what do you guys have on your books? How do we get this? And talking to some of the big banks. Can you absorb these? What do we do to get rid of this glaring problem that will slow the economy?
When you say there's a buying opportunity for some of these banks, Pete, which banks? Where'd you find them?
So I'm going to go in the index. I'm going to go in the mid-market, middle-level index. I'm trying to look for the larger ones. Again, I think SVB in particular, it had massive amounts of deposit growth. So it tripled its balance sheet right when yields were the lowest. A lot of other mid-sized banks only saw marginal growth. I think they've managed their balance sheet better. Again, it's almost like some people skip the class of finance where they talked about the S&L crisis, right? Which was a bunch of banks and savings and loans getting in trouble for owning long-dated treasuries, no hedge. So why they did that, I don't know. So I think there's a lot of better managed people. They will get this sorted out. People will return to that, and that's where the equity growth is going to come.
Pete, just a final one from me then. If that's the call on the single names, the banks, what's the call on this bond market move this morning? Down 50 basis points at the front end. Pricing out hikes, pricing in cuts, not just here, but at the ECB as well. What's your response to that?
So I think it's largely right. I think the Fed has to be off the table for now, right? I think they pushed on rates until something cracked. Well, guess what? Something cracked. So now's a good time. Whoa, all these lag effects we've been talking about that everyone's been poo-pooing. Well, here's a lag effect, right? This is an obvious lag effect. It's time to push back. And I would not be surprised to see talk about large-scale asset purchases, which I think is the preferred term at the Fed now for QE. So to see QT stop would not be surprising, and maybe something to support the market. I think we're back in crisis mode. And remember, to me, bank runs are way, 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 way more important than inflation. So that's what they've got to be arresting. And it's not just here, right? Europe has the same problems. That's what started last night's, we started futures went very high on the announcement, and then Europe started selling off as everyone realized every European bank is sitting on these same unrealized bond losses. So that's going to be the focus. Today's rally helps on that, but it's not going to be anywhere near enough.
They've been getting hammered this morning, that's for sure. Pete, thank you, sir. As always, Peter Cheer there of Academy. Broader market looks like this. 17 minutes in, the S&P down more than 1%, the Nasdaq down 0.9%. Kelly Lyons, you watched the early part of the session. Those banks got absolutely hammered.
And they're still getting hammered. We now have the likes of Western Alliance back open for trading after a volatility hot, and there has been no recovery in the shares, still down more than 76% on the day right now. And remember, we're only 17 minutes into this session. Schwab also is back open and trading. It remains down about 20%. And the halts are still in place for First Republic, which was down 66% at the time it was halted for volatility. And Regions Financial now back up and trading, and it is down still about 15%. These are incredibly massive moves, John, and they also are bleeding through to an area of the financials that we did not see the bleed through on Friday. That would be those big diversified banks. They, too, are coming under pressure this morning. Bank of America, Citi, Wells Fargo, all down in the ballpark of between 6 and 7%. The relative outperformer among the banks this morning is JP Morgan, but it too is down about 2.6%. Broadly, the KBW Bank Index at this point, John, down 12.5%. It is really just an absolute bloodbath. It does not seem that confidence in this sector has been restored by the regulatory moves over the weekend. As you were just discussing with Peter Cheer, it's a question of whether or not it was enough. And what the market seems to be saying today is no. At this point, it is not enough.
Equities more broadly, and Katie, thank you. Negative 0.75% on the S&P. I have to say, given the drama in the financial sector, and this is to do with weightings, I know, but the index level not really capturing that drama. The S&P 500 down 0.6%, and the Nasdaq now recovering. We're down just 0.25%. Tech at the epicenter of a lot of this. Ed Ludlow on the West Coast with more. Good morning to you, Ed.
Good morning, John. Yeah, look, the biggest concern in the near term is the real-time access to working capital. I've been speaking with the FDIC this morning, and in the case of Silicon Valley Bank, they are pledging normal operating hours. Here on the West Coast, that means 9 a.m. local, 12 Eastern, and a lot of venture capitalists and founders I'm speaking to are literally trying to get access to their money. It's one thing to get backstopped and have 100% of deposits insured by the federal government, but if you can't access it in real time, that's a real problem. When we look to the equity markets, a lot of those most exposed to Silicon Valley Bank in the tech sector, names like Roku, Roblox, actually seeing pretty significant declines early in this Monday session. Roku, as an example, has about $487 million, or a quarter of its cash on hand when it comes to Silicon Valley Bank. We're learning increasingly, according to sources, that the relationship between VCs, founders, and other tech companies and SVB was incredibly complex and it was a big web that goes well beyond just having deposits. Many of these companies also use other services like loans or advisory services, and much of that, according to sources, was conditional, right? So if you took a loan with Silicon Valley Bank, you would get more favorable rates on the deposit side as well. That is now coming to the fore, and actually what we've learned over the weekend, John, I've had so many phone calls. Venture capital firms are not sort of flush with cash themselves. And so what they've had to do is plug gaps for their portfolio companies needing them short. There's a lot more to run on this story.
Ed, thank you, mate. Appreciate the coverage and looking forward to the show a little bit later. Ed Ludlow there with Caroline Hyde on the Tech Show coming up later on this afternoon. Here's the story for you this morning. The equity market has truly been all over the place. The low, we were down 1.5% on equity futures, this is. The high, we were up by 1.9%. We've now got the cash equities trading in the last 20 minutes or so. So the S&P 500 is negative just 0.2%. But one consistent theme right the way through the last several hours or so is just this relentless bid at the front end of the curve. Down 48 basis points on a 2-year, 4.1% on a 10-year yield. We're down by about 20 basis points, 3.49. And the theme, whether it's United States, Treasury market, Europe, Germany, the bond market, we're taking out rate hikes, we're pricing in rate cuts. Amy Wu Silverman of RBC had this to say. Despite the fact that owning downside meaningfully underperformed last year, investors are finally focused on tail risk in the market. There is definitely more room for far more volatility. I'm pleased to say that Amy Wu Silverman joins us right now. Amy, you said it repeatedly, and thanks for being with us. When things get messy, all correlations go to 1. So where'd you get that downside protection now?
Yeah, it's tough, right? You know, not to be a bearer of further bad news, but as we start hitting even lower levels in something like KRE, you're going to start getting these gamma dynamics that happen with it, which is going to exacerbate further downside. So look, if this is something we think continues, you're actually better off in these general indices like S&P, where the moves have been a little bit less muted, but the tails are actually starting to tick up substantially. People are really taking an interest because, you know, something that is more of an unknown has hit this market and is starting to price through.
Amy, you've said it repeatedly. Some of these strategies underperformed last year. Why do you see that changing this year?
Yeah, you know, the big difference between last year and this year is we did get that move down. We did get that drawdown, but it was very orderly. It was this orderly grinding path down. And this essentially has been the opposite, you know, not a technical term, but it's been just quite gappy. And when you come in to work and you have stocks that are down, you know, 70, 80%, that's what volatility likes. That's what reprices volatility higher. So, you know, those trades, those owning puts that didn't work out for you last year, you know, they're realizing far more this year, and you're going to get those payouts on those downside tails.
Have we gone, Amy, from saying things are looking resilient to things were looking complacent?
It's funny because even last week, as we spoke to investors were bearish. But when we asked them, are you hedging? You know, they said no. Essentially, you know, they had their money in high yielding cash. But even now, you know, you can see that even if depositors are insured, that doesn't go for the equity, that doesn't go for bond losses. And remember, we were, John, at a place where tail protection was at 5-year lows coming into this all through the year. And, you know, that's going to change quickly as we get through those VIX levels, you know, sub 20. That's where we were before. Now we're hitting 30.
That's the question I wanted to ask you, Amy. Just looking at the situation at the moment and through the bond market, I understand there's a massive bid this morning, but still 4% at the front end of the curve. Why wouldn't I just go and buy that, run away and hide and come back another day?
Yeah, that's a great question. And look, I think we're going to see a little bit of that, this, you know, shoot first, ask questions later, get off sides. But essentially what happened is year to date, people really came back into the equity markets. So there was this kind of low participation heading into last year. People are back. And, you know, what's the quickest way to get downside leverage? It's actually to go into options, which is why I think you see that downside skew moving and getting bid up.
Amy, can I just finish on the VIX? It's often called on Wall Street, and some people criticize the people who use this phrase, but it's called on Wall Street the fear gauge. How useful is it as that?
So, you know, the VIX was claimed to be dead for a while this year because zero DTE, the zero data expiration trading, was kind of front and center. Look, when we have these sort of systemic problems coming from the banks, coming from these individual names, what have you, I think the VIX becomes more relevant. We're starting to see now that correlation, that inverse correlation is coming back, whereas before that inverse relation had broken down. And I think that continues because, you know, we saw 50 Cent come back, the huge VIX call buyer, and we're kind of seeing large institutions step in and say we really do need some downside protection here.
Amy, thanks for this morning. Looking forward to the coverage from you and the team over at RBC through the week. There's a lot to write about. Your equity market negative about 0.25% on the S&P. Trying to stage a recovery here on the Nasdaq at the moment, down about 0.1%. Want to get you some sector price action with Abby in just a moment. But here's a check on the bond market. Yields in at the front end still by about 49 basis points. With more, here's Abby.
Hey, John. Well, you know, it's pretty interesting because with all of this fallout from the Silicon Valley Bank collapse, we actually have the S&P 500 at this point well off of its low. So to Peter Cheer's point in terms of buying, we're seeing that, but it's in the defensive sectors, utilities, real estate, staples. Importantly, though, tech is almost even. Apple's up 1%, Microsoft. So it's going to be really interesting to see how this shakes out through the day, John.
Abby, thanks for that. This market story is just phenomenal to follow. Painful for a lot of you, I know. So let's work through the next couple of days. Here's the trading diary. Coming up still, CPI tomorrow morning. Yes, it's still a big deal for this Federal Reserve and others too. After that, we still need to get through PPI and retail sales on Wednesday. Then, on Thursday, the ECB was expected to go 50 basis points. Will they get a rate decision and a news conference with President Lagarde? We will take that in full on this programme. That's the schedule so far. Then you'll hear from Treasury Secretary Janet Yellen appearing before the Senate Finance Committee. That's going to be must-watch later this week as well. And finally, round out the week with the UMich Consumer Sentiment Survey. Right now, Friday feels like a long time away. From New York City, thanks for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.